The EU and Canada just declared economic war, and as you're about to see, U.S. consumers are going to get screwed. I'm Steve Van Metre. The tariff war is exploding and prices are set to spike, and for American households, it's going to be all-out hell. Plus, we have a sponsor for today's show. I'd like to welcome Metre Clean Technologies back. You can find them on the NASDAQ under symbol ADUR and on the CSE under symbol ACT. And DeBoral Capital recently initiated a buy signal with a $50 price target that's 10x potential from where it's trading today. Stay tuned to the end of the show for a full breakdown of the report, or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where I want you to understand what just happened, and then we'll show you why for American households it's going to be all out hell. As the EU targets $26 billion of U.S. products in tariff retaliation, as now the tariff war is heating up and in a major way, and this is going to have a direct impact on U.S. households, as you're about to see. The announcement came hours after the U.S. administration imposed 25% tariffs on steel and aluminum imports in a massive escalation of the trade war between long-standing allies. And I want to know, if you're upset that prices are about to rise, hit the like button. Do you think this is going to affect you? Weigh in the comments. I want to know what you think is about to happen, because we firmly believe that in a world fraught with geoeconomic and political uncertainties, it's not in our common interest to burden our economies with such tariffs. Now, this is what we're hearing from the European Union, and it makes perfect sense, because if you listen to what's going on in Europe, their economy is slowing down. We've talked about how Germany's manufacturing sector is in a depression, and it's pulling down the manufacturing sector all across Europe. And so what this means is there's going to be lots of people on the unemployment line, and now that these tariffs are coming online, well, what it threatens is to put even more people out of work. That's something that Europe doesn't want. But the challenge is for American workers, well, they're going to face a similar story, and soon. In the European steel market, producers are bracing for a twofold impact, with European exports into the U.S. set to fall and the region's imports set to rise as the metal is rerouted away from the U.S. And that means those cheap imports that were coming to the U.S. are now going to head over to Europe and flood their market. And this is one of the problems the EU is going to face, is they're going to see a lot of cheap imports of steel. And again, for their domestic industry, it's going to be a lot of people out of work. During the first term presidency, for every 3 tons of steel deflected from the U.S. market because of tariffs, 2 tons went to the EU. So you can see the European Union is going to get flooded with cheap steel. Now, I want to know what you think of tariffs. Are you for them? Are you against them? Weigh in the comments. Let me know. I'd like to know what you think, as Canada just unveiled new tariffs of $21 billion of U.S. goods. So now we see not only European Union escalating, but Canada joining in the fray, making this an all-out war that's set to explode in a major way. And the Canadian retaliation will target U.S. steel and aluminum as well as other goods, matching the new U.S. levies dollar for dollar. Now, if you're frustrated that this means prices are going to go up, hit the like button, because as you're about to see, this is going to impact every American household, not just from products that are coming into the country from Europe and Canada, but it's going to hit us from a domestic production standpoint. And that means, as you're about to see, a lot of U.S. workers are about to lose their job. But we did get some positive news today. The market liked the fact that the consumer price index slowed, but I'm going to show you why for American workers this is even worse than the fact that we're getting tariffs. As U.S. inflation eases, offering some relief ahead of tariffs. And so the idea here is that if price growth slows down, this is good news for households, because they're drowning in inflation. Their incomes haven't been keeping pace, and that means that we need to see inflation come down. But there's a big problem, because when inflation comes down, well, it also means pay comes down. That's going to be a challenge, because that means a lot of employers, as they face higher tariffs and slower sales, they're going to let go of workers a lot faster than they planned. And the consumer price index increased 0.2% after a sharp 0.5% in January, indicating that we're seeing a slowdown in the rate of inflation. Excluding food and energy categories, a so-called core measure rose 0.2% as well, indicating that American households should be starting to get ahead a little bit. But the reality is, we know that's not the case, because the consumer price index doesn't take into account that everything that a household spends on. The BLS said nearly half of the advance in the overall measure was due to shelter, but it decelerated from the prior month. And that's pretty normal. We see shelter prices move very slowly compared to the broad consumer price index. But the issue here is we're still facing rising rents. So there's many American households that are in leases or in rents, and they're looking to see that cost go up. And that's going to have an impact on the other side of their spending. That's going to hit the discretionary side of the economy in a big way. And here you can see the broad consumer price index in blue against the shelter average, that in red, both on a year-over-year rate of change. So when we talk about hell is coming, well, it's not just in the fact that rents are going to go up. We're going to show you how the tariffs are going to impact every American household. You can see going into the dot-com bubble that inflation cooled off, but shelter prices continued to rise before they slowed down with a lag. You can see that same lagged effect going into the pandemic and through the pandemic. And look at now, inflation's come down a lot, but rents have not come down enough. That means, again, many American households are facing higher rents, on top of the fact that many businesses are going to face the same problem. Airfares, meanwhile, fell 4%, the most since June, as several carriers warned of weaker demand ahead, despite the fact we heard from airlines that this was going to be a booming year. And we said this was not likely to happen because consumers were seeing their income grow slow, and that meant they had to dedicate more money to the essentials, to energy, to food and rents, less money on the discretionary side of the economy, and that's exactly what we're seeing now. Prices of new cars and gasoline also declined. What we're seeing here, consumers front run the tariffs. They started to buy cars. Now they don't want to touch them. But one thing you can control, because you can't control a lot about your energy usage, you can do something about your food consumption, maybe eat out a little less. But there is one big part you can control, and that's drive less. And so we're seeing Americans spend less on gasoline. Grocery prices were little changed after a big increase in January, actually falling when you exclude eggs, while car and health insurance costs rose at a more moderate pace. So despite the fact that energy prices went down a little bit, what we saw is health insurance costs and car costs rise. It's going to have a bigger impact on budgets than a few pennies in gasoline. But let's take a look at the impact of gasoline on inflation as we look at the consumer price index against regular all formations gas price. That's shown in red both on a year-over-year rate of change, and we can see the steep rise in gas prices over the last several months. That caused inflation expectations to rise. Now we're seeing it reverse and start to slow down as disinflation takes hold in gasoline prices. This is going to put some downward pressure on the CPI just at the time when tariffs are about to hit, and you're going to see prices go up. But there's a big problem with that, and I'm going to show you why here in a moment. It's going to be all-out hell for American households. And while Wednesday's report offers some relief, several measures still indicate that inflation is rearing back up again. And with President Donald Trump rolling out a series of tariffs, prices are expected to rise on a variety of goods from food to clothing, testing the resilience of consumers and the broader economy. Well, it's not going to test the resilience because consumers can't afford prices where they're at today. So where tariffs are supposed to come into play is they're intended to be a tax on imports. And what this is going to mean is prices are going to go up across the board. And you're going to hear employers say, well, we had to raise our prices. It's everything to do with tariffs. Our costs are going up. There's nothing we can do. Now, one of the challenges here is this is not going to be passed on to the workers. Workers are going to watch prices go up. They're going to see themselves priced out of their own products their company sells because they won't be able to afford it. And of course, employers are going to say, sorry, this is a tax. We're not benefiting from this. We're just passing this on. There's nothing we can do about it. And this is a challenge because in terms of resilience to the American household, well, you're going to find out the spending is going to collapse in a big way. We're going to see employers forced to lay people off. And it's all coming back to that massive CEO meeting that we had in Washington that Trump hosted just the other day. And I know he told them, he said, don't lay people off, but they're going to have no choice. You're going to see layoffs are going to accelerate and soon. The combination of easing inflationary pressures and rising downside risks to growth suggested the Fed is moving closer to continuing its easing cycle. Well, I disagree with that. I think the Fed wants to keep rates where they're at. And they're going to use inflation as an excuse. Of course, we know that Trump is no fan of Fed Chair Jerome Powell, and one way he can stick it back to the current administration is sticking to his inflation mandate, one we know is likely to go higher due to tariffs, but ultimately we'll find out if consumption drops enough. Perhaps we we won't see it happen at all. Policymakers also pay close attention to wage growth as it can help inform expectations for consumer spending, the main engine of the economy. But we've talked about wage growth over and over, and I've told you it doesn't matter, because if you have a job, even during a recession, there's odds that you'll see your wage go up. But the problem is, during a recession, lots of people lose their job, and some of those people that do have one see their hours worked get cut. So in the end of the day, it's not about your pay rate, it's about your take-home pay. The problem is that it's going to head lower. A separate report on Wednesday that combines the inflation figures with recent wage data, again ignoring the true story of the economy, showed that real hourly earnings were up 1.2% from the year before, the most in 3 months, suggesting that workers should have no problem absorbing higher prices. But we know they can't. And I'm going to show you why in this next chart, because as we take a look at the consumer price index, it's all about total incomes. As we look at average hourly earnings multiplied by average weekly hours, this is production and non-supervisory employees. And what do we see going back to the late 1980s? Inflation is rising, and those rising prices get passed on to workers in terms of higher wages. They see wage growth, they see hours worked go up, and the next thing you know, incomes start to peak, inflation continues to go higher. So you can think this could be what we'll see with the tariffs, and next thing you know, we're right into the 1991 recession. But look what happens between, say, 1992 and 95. Inflation is pretty benign, and so too is wage growth. And then look what happens around 96. Wage growth spikes higher, inflation goes up, everything looks to be okay because workers are benefiting, but they don't benefit from the rise of inflation from 1998 right into the dot-com bubble, and that was a huge problem. Again, we're facing this now. Everything works if you see inflation being passed on to higher wages, just like what happened in late 2003 into 2007, but that came unwound going into the global financial crisis. And you can see in instances over and over, what matters for households isn't the price of goods, it matters is if they participate, if they're seeing higher wages, and we know tariffs are not going to lead to that. Now, of course, the White House is telling us that the whole objective here is that tariffs are going to lead to less taxes on Americans, and that's why they're looking to pass a tax cut. The problem is the tax cut isn't here. If it was here today, this might be a whole different story, and that's why hell is coming for American households, because prices are going to go up, workers are not going to participate in that, and in the meantime, they're going to see no financial relief, at least in terms of a tax cut, not for a while, until perhaps we'll find out if there's going to be one. I don't know. Weigh in the comments, what do you think is going to happen? Because here's the real story. Yes, average hourly earnings, they can rise. We see them in blue. This against average weekly hours, both on production and non-supervisory employees. And what do we see? Going back to the late 1980s, average hourly earnings are rising. And so, of course, policymakers say this is a good thing. But despite the fact that wages were going up, the amount of hours worked were in a decline. Again, total incomes peak under that scenario and start to roll over right into a recession. You see that happen going into the dot-com bubble. Policymakers were celebrating that hourly earnings were rising. At the same time, workers were complaining their number of hours were getting cut. Total incomes were falling. You see that happen going again into the global financial crisis. And you see that happening now. There's this bit of celebration that everything's going to be okay. The problem is workers are taking home less and less money. They're going to face higher prices, and employers will not be able to pass these higher prices onto their workers. And sure enough, that transmits right into more people hitting the unemployment line. As you see, average weekly hours still in red against continued unemployment claims in blue. And as hours go down, employers start to say, I don't need as many employees. I'm going to give the employees that I want to keep more hours. That means you see workers hit the unemployment line without any opportunity to re-enter the workforce. You go right into a recession. That happens again going into the dot-com bubble. Hours worked come crumbling down. Workers go to the unemployment line. Nobody wants to hire. Right into a recession. You see that happen again into the global financial crisis, and you can see it happening now. Hours worked are plunging. Workers know this, and they're nervous about this. This is why we're seeing in the surveys people are saying, look, I'm concerned about my future income. I'm concerned about my finances and my job, because they're seeing their hours get cut despite the fact they're getting pay raises. And the big risk is they know there isn't another job out there for them. And so you can see hell for American households is coming and coming soon. And we get some evidence that we're about at the end of the credit cycle as we turn to mortgage data. As U.S. mortgage rates dropped for a sixth straight week, but that's not the real story. What did we hear last month? The consumers went and tapped out their credit cards in a very aggressive way. Now they're going to the one last place they can get credit, and that's their home. And there's a good reason why, because everybody remembers the financial crisis when they had equity in their house, they had ability to tap credit lines, and banks quickly took that away. This time consumers say, no, we're going to get ahead of that. As the Mortgage Bankers Index for applications and new homes purchased 7%, but forget that. The refinancing gauge jumped more than 16% to the highest since early October. What you're seeing from households is they're grabbing cash, and they're grabbing it very quickly because, again, they know if they lose their job, the banks won't give them a loan. But the stock market reacted positively to, of course, the cooler CPI. You may remember from this weekend, I said if we got a hot CPI report, the market would sell off, but don't think this is going to last, because this morning stocks erased gains and they started rallying back in late afternoon trading. But look at this. If you understand what's really going to drive the market, if you look at average weekly hours of production of non-supervisory employees, this still shown in red, against the NASDAQ 100, you see at some point as hours worked go down, the market responds. You can see that happen going into the global financial crisis. And you can see hours worked have been in decline since 2021. The market's defied those odds, but if history is any guide, what we're likely to see is more Americans get their hours cut, facing job losses as the tariff war escalates. And what that means for equity prices, well, it could be going the wrong way. But something we do think is headed higher, that is the stock for our sponsor of today's show, Clean Technologies. You can find them on the NASDAQ under symbol ADUR and on the CSE under symbol ACT. And we've got that DeBoral Capital report. They've got a $50 price target with a buy signal. That's a 10x potential from where they're trading right now. This is a huge opportunity. Let's check everything out, everything you need to know in the pinned comment and description below, because when we take a look at what's going on with this report, because Clean is a developer of patented water-based technologies to chemically recycle waste plastics, convert heavy crude and bitumen into lighter, more valuable oil, and transform renewable oils into higher value fuels or renewable chemicals. And this has caused DeBoral Capital to put a buy rating with a $50 price target. Here's a recent report from refuse to revenues as Aduro's transform technology is taking off. Now, if you want this report, you have to contact your securities broker and get it from them. But let's take a look. In 2021, they shifted their focus to tackle the 90% of global plastic waste that remains unrecycled, demonstrating the ability to process contaminated feedstock with lower costs compared to competitors with potential commercialization by fiscal year 2027. Increasing global regulations on plastic recycling and pressure on oil companies to decarbonize aligned with Clean's HCT platform, which can convert waste into circular feedstocks and potentially support the EU's goal of tripling plastic recycling volumes by 2030. Clean's versatile ACT platform is capable of deconstructing hydrocarbons and waste plastics that has garnered interest from major companies like Shell and Total Energies. DeBoral Capital initiated their coverage on Clean, again on the NASDAQ under symbol ADUR and on the CSE under symbol ACT, with a buy rating and $50 share price target based on averaging the output of a 10-year DCF and DEPS model. Plastics, bitumen, and renewable energies are all potential end markets for the company, making up a total of $290 billion estimated addressable market, with recycling plastics the furthest developed commercial opportunity at hand today. An ACT technology platform has a proven basis for plastics, bitumen, and renewables in markets, but additional applications for its innovative technology are still being researched. Clean's key targets for fiscal year 2025 revolve around three key objectives: development of the company's pilot plant and further clarity on its plans for commercial demos, the commercial engagement program, and furthering the company's patent portfolio. And Clean stands out in the recycling market. It faces no direct competitors, with other companies focusing on specific types of plastics rather than offering a broad solution. And while some competitors target niche areas, Clean's technology can handle multiple types of plastics more efficiently, making it a more competitive option in the industry, which is why notable large companies working with Clean include Shell and Total Energies, with 7 paying customers today. So now you can understand why DeBoral Capital has put a $50 price target on Clean. Again, you can find them on the NASDAQ under symbol ADUR and on the CSE under symbol ACT. And if you're looking for a copy of that report, be sure to contact your securities broker. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.